What's up, everybody? So, we're going to go ahead and review my thoughts on Alibaba earnings. And the first thing I have to say, guys, I sold out of all of my Alibaba. I'm just kidding. Okay, so let's go ahead and move on to my thoughts on the earnings. We'll go over some positives and some negatives. Okay, first of all, we'll go ahead and scratch what's on the surface because that's always what seems to affect a stock. So Alibaba missed revenue expectations by just a little bit, but they beat earnings per share estimates. Now, most of the time with these earnings lately, if a company misses on anything, they go down dramatically. And Alibaba did go down a little bit, but pretty much kind of came back towards the end of this trading day here, and the day was kind of almost a wash for them. But now that we've scratched the surface that everyone always seems to look at, I want to point out a couple things I happen to notice in this earnings presentation. Okay, so I have their financial highlights up here. So the first thing I noticed is that for Chinese commerce, which makes up the majority of their revenue, still 71%, their Chinese commerce was only 7% year over year. This is obviously a stagnant number and their slowest growth they've ever had from their Chinese commerce. Now, in Alibaba's defense, numbers are always relative. What I mean by that is 2020 was an explosive year for them. COVID kind of had this setup that just was the perfect environment for them to explode. So when you compare 2020 to 2019, 2020 looks explosive. But because 2020 was so explosive, now that we're getting kind of back to normal here, it made 2021, especially now at this quarter, look a little more lackluster in terms of growth. Now back to it, the other thing that kind of stuck out to me is their cloud growth. Now cloud growth really shouldn't have been affected by the pandemic or anything that was going on. That was more of a commerce thing. Yet, cloud growth is slowing. It could just be a one quarter kind of thing, but cloud growth is down to 20%. And when there's big talk of cloud growth making up a good amount of their revenue in the future, you don't want to already see it slowing. Especially when you look at cloud growth from a company like Amazon, and it is definitely much higher. So, I mean, that was the bad, but let's talk about some of the good, in my opinion. They managed to do pretty well in their local consumer services. And that included something that's very similar to like what we have in the United States here with like Uber Eats or Grubhub, etc. They have their own kind of service that really saw some explosive growth. I also want to reiterate that a lot of their growth that looks stagnant now compared to 2020 is because of the fact that 2020 was so explosive. Which means if a year like 2021 is kind of getting things a little more back to normal, then full year 2022 compared to 2021 will probably make the growth look pretty good again. But right now, they are being compared to 2020, which was an explosive year due to the perfect setup. Another good thing is that management for Alibaba clearly seems to think that the company is a steal at these prices and very undervalued. As they announced, they pretty much think it's insane that it's still at this price, and they will continue share buybacks when it's a steal at these prices. Another thing I think we should point out is the last time Alibaba was down to these levels price-wise was literally back in 2017 around the same time. And if you want to look at their free cash flow for around that time versus now, the company looks significantly stronger, has way more revenue, and has way more free cash flow. Now my overall take on this is Alibaba has certainly had their fair share of headwinds, but this is certainly not a position I would just panic sell out of right now. But this is a company that I still think is deeply undervalued. I've already done a valuation on Alibaba before, and I've run an extremely conservative DCF model, one that quite literally only accounts for 10% revenue growth on average over the next 5 years. And the company comes back at deeply undervalued. Heck, I may even run another model that only accounts for 5% growth, and I guarantee it still shows that the company is very undervalued. Okay, everyone, that's going to wrap the video up. I hope you enjoyed watching and you have a great day.